welcome to this special Davos 2016 broadcast. What a beginning of the year it's been for global markets, and the headlines continue to dominate the conversation here in Davos. Let's speak with Dixit Joshi, Managing Director at Deutsche Bank, who's an expert in global institutional equities. Dixit, thank you very much for joining us here. It's a lovely sunny day, but you wouldn't see that in the mood here at all. I think the question everybody wants to know is whether this is what you would compare to 2008. Last night I was at a dinner where George Soros was speaking, and he said this is like 2008, except that time it was subprime, and this time it's China.
In many ways, Menaka, it's actually worse than 2008. If you just look at the start that we've had this year, much of the move that we had has come as a consequence of the devaluation out of China.
Right.
And that's similar to the moves that we saw last August as well, when the Chinese deval created a lot of chaos. But if you look at the moves in the equity markets, I think they're quite out of line versus what the fundamentals actually say. If you look at global growth, while global growth is uninspiring right now, we're expecting, let's say, around 3.3% for this year. It's certainly not a disaster.
Yeah.
And so I think we've had an overreaction, partly because of the uncertainty around Chinese growth, which is quite understandable, and also the uncertainty around Chinese foreign exchange policy, which I think as we see more clarity around the foreign exchange policy, I think we might get some more calm.
If it's just an overreaction, then like you said, it will calm down. If it's not, and if it's fundamental, then what happens?
So I think we have had a lot of adjustment already happen in the markets, and I think some of this does get lost. So, big focus on energy, for example, this year. If you look at high yield spreads, energy spreads have moved by 1,300 basis points in the last 18 months. If you look at ex-energy spreads, they've moved by about 350 basis points. So the market's already reacting to an environment that becomes more tougher, has more corporate defaults, and we have seen volatility go up.
Yeah. Is this a market addicted to monetary easing, quantitative easing? Because, we just had to hear from the ECB yesterday, and he indicated he'll take more action in the next meeting. And there you've got it. Global markets are all back and, smiling. And you've got to think maybe there is no way out except for cold turkey.
I think we have had, this unprecedented experiment, and we are, I think, in fresh territory here. And we've had about 7 to 8 years of one-way easing right now. So you have the Fed, where we're expecting 3 rate hikes, who might not actually do the March rate hike.
Yeah.
You have the ECB with Draghi confirming yesterday at the ECB that actually would continue with easy monetary policy, and you have the BOJ injecting still around $60 billion a month into the markets. So it looks like that's here to stay. Fortunately, what QE has done is actually underpin growth, for example, in Europe. So we're achieving growth of around 1.5%. I think the bigger issue is really when the structural reforms get done in Europe. And I think that will be the telltale sign that would allow us to ease off from quantitative easing.
Can I argue, Dixit, that the structural reforms will never get done until the monetary tap doesn't shut off? I mean, till you've got that going, till you've got that giving people this false sense of security and this false sense of calm, no government is going to make the difficult decisions that it has to.
So I think the good part here is that Europe's actually begun to have the conversation. So if you look at the Brexit debate, potentially that might have spurred some of the conversation around this, which is when do we have a focus on growth and when does Europe have a focus on efficiency? So my hope is that that gets addressed, because it's only through the structural reforms and increase in productivity that I think we can wean ourselves off quantitative easing.
Okay, but you still didn't answer my question. When do you expect, for this monetary tap to shut down and for markets to come back anywhere close to real levels?
So I would look at the Fed as a great example. So I think by signaling, Governor Yellen, by signaling that we actually want to wean ourselves of the policy. Now, you might stretch out that timeline depending on what happens with the markets. Clearly, what's happened out of China in the first couple of weeks of this year might actually lead to the first hike or second hike being postponed. But you have started seeing the markets now readjust. You have started seeing emerging markets reprice. You're starting to see money flow back into dollars. So all of the easy money that flowed out is actually starting to retreat somewhat. Now, that will cause some pain in some sectors and in some countries, but it's a necessary adjustment that we need to make. So my point would be that actually the markets are adjusting right now. Potentially further adjustment will come, but we've started on that journey as opposed to ignoring the fact that we'll reach higher rates sometime.
Fair enough. The IIF put out some data which suggested that in 2015 we saw somewhere in the region of $700 to $800 billion of outflows from emerging markets. This is equity and debt, included. And that this year we'll see another $400 billion of outflows. Now, what is that going to mean for markets like India that are substantially lower from where they were when the Modi premium was playing out?
So the emerging market story, I think, needs to be separated between the sovereign and the corporates. And if you look at the sovereign balance sheets right now, sovereigns have higher reserves, sovereigns have lower debt, they have a stronger capital account, current account position right now. Their currencies are more flexible and their currencies are cheaper. So I don't think we'll have a crisis like we did in the 90s around sovereigns.
Okay.
If you look at the corporates, though, a slightly different picture. There's around $3.5 trillion of dollar-denominated debt issued by emerging market issuers. About, let's say, a third comes from China, and around 15 to 20% between India, Turkey, Brazil. The good news with those issuers is much of the issuance is from what we would call high-quality emerging market countries, China, Korea, Singapore, etc. But no doubt, with a higher dollar and a higher cost of funding in dollars, companies that have not hedged their exposures or don't have large dollar earnings are going to be exposed, and I have no doubt we'll see some corporate bankruptcies in the space. So 16 looks like it might be okay, just given the amount of cash on hand to meet redemptions, liabilities coming up. 17 could be the real test.
Okay. You said in the initial part of our conversation that the markets are, in fact, readjusting to the realities of this world. How much pain is left? You know, actually, the question I do want to ask you is how much lower are we going to go in India? But I know you don't do those kind of levels.
As a good trader, you try not to call the bottom, and you try not to call the top.
Are we anywhere close to the bottom? Are we? Do you see that there's more pain left in this?
So I think, it's illustrative to look at, we talked about China, look at, for example, oil, which has also caused much of the movement, for example, in the United States in the equity markets. You have had a wave of indiscriminate selling, which is also related to oil. If you look at oil, oil's down about 75% from 2 years ago and down 25% now. That's not dissimilar to the last time we saw this in 2008, when really because of demand, oil had collapsed. But if you look at the moves in the market, they're overdone. Healthcare's got sold off, banks have got sold off, technology's got sold off, for no other reason except there's a de-risking, which is a consequence or a derivative of the oil market. If you look at the moves or the sentiment around oil, which is filtered into the broader market, it's out of kilter with the real impact that energy can have. So the energy sector makes up roughly 5% of capex in the United States, not more. Makes up less than 0.5% of employment in the United States. If you look at earnings per share on the S&P, ex-energy, earnings per share were up 2.5%. But if you look at the S&P, earnings per share growth was down last year slightly. So I think
this is an outsized reaction.
I think it's an outsized reaction. A lot of the adjustment is taking place currently. As I mentioned, high yield spreads, etc. That's playing out in the market right now.
So are we anywhere close to the bottom in India?
I would say India's in a slightly different position, has been for a while, in that the fundamentals in India versus the rest of the BRICS and the EM space have actually held India in a different state. So if you look at currency volatility, Governor Rajan highlighted this at the World Economic Forum this week, that India's seen less volatility, probably more volatility than people might like, but less volatility than other emerging markets have had, because of the strong position that India had entering this phase.
All right, we'll leave it there. Dixit, thank you so much for speaking with us. Have a great rest of the week here in Davos.
Thank you.
Thanks very much for joining us.